So today's topic, I want to focus on losses. So let's say, this bear market just drive you nuts and you lose money, right? And if you lost money on the stock market, what exactly you are looking at? A lot of times people will say that, Ying, I know, because when I lose money on the stock market and there's only $3,000 I can deduct, because more than that, it is saved for my future. When I have capital gain, it can offset. Otherwise, I lose it. So, it is not wrong. And almost every single statement I hear about the capital losses, it was a correct statement. But what we are good at is to kind of give you that overall, general overall look. And we talk about stock losses and losses for tax purposes. No responsibility disclaimer, just because knowledge is here, I'm giving you knowledge, but that doesn't really guarantee that what I give you is 100% correct. Knowledge do outdate, and my understanding can be limited, but what I give you is the experience I have. And also in the background, our staff had already done the research for me. So we will say that you take your responsibility, I take mine, and together we can be a really good team. So now let's talk about stock losses. And in here, I am going to share a screen with you to my drawing board. So in tax world, in business, there's no such thing about loss is loss. And the loss is win, loss is gain, and the gain is gain. So the reason we say that is because losses in so many ways is preserved, or it is being offset by the income. So your losses would reduce your tax burden. There is, generally speaking, from very high level, if we just talk about losses, and we will talk about the losses that coming from what we call the ordinary losses, and also losses coming from what we call not ordinary losses, they're passive losses, right? So ordinary losses. Give me a second. Let me see. What is my pen right here? Ordinary losses. So what about ordinary losses? If your losses are ordinary losses, that means can offset gain right away. And approximately, generally speaking, can offset 100% of your losses. Observation. Of course, there are different rules, but here we're talking about in general, for you to simplify your tax world, to just kind of understand how tax works. And you want to say that, okay, if I have ordinary losses and I also have ordinary gain, or I have other gains that can offset, okay, then different from ordinary losses is what we call the passive loss. Means what? Means losses you did not trigger. Losses not from doing things. You run a business, you lose money, and that's ordinary loss. But if you put money in the stock market, you let it run, then you lose money, and you have a full-time job or you have a whole business to run. This is just something you put on the side, and you had your financial planner doing that for you. That is your passive losses. So in the passive loss world, you heard of this famous $3,000, right? You know what I'm talking about. So you will say that, oh, Ying, are you saying that all the stock traders, all the stock players, people like myself, we are all passive losses? No, not all of you. Some of you will qualify for what? some of you would qualify for day trader. Am I right? So if you are a day trader and you are on the other side, you are the ordinary losses, ordinary income person. But if you are not day trader, you trade amateurly, and you have other people investing for you, and that's your passive income, passive losses. So if you lose in this market right now, and I know a lot of you coming in today's talk is because the market is not doing you good, and you have loss, and you have more than $3,000 loss, and you don't know how exactly to mitigate that. And I had one client and called me. He lost so far, not the end of the year yet, but so far he lost close to $3 million on stock market. So he was like, Ying, I am actually always reported that under 1099 B, and we're passive. It's going to be a passive losses, so I won't be able to deduct it until my life is over. $3 million, and you can only deduct $3,000 each year. Okay, so this is what we call the capital loss, passive loss. Right. So now we just used stock trading person as an example. If you are a day trader and your activities are on the trading, are going to be counted as a business. Am I right? Because it is business, so it is going to be a business income, business loss. And right here, there is a huge knowledge chunk right here, folks. If you are a day trader, you are running the day trading business, like you are saying, and you are counting your income, your losses, like a real business. Don't forget to do a mark-to-market election. Market election can only be done before April 15 and the 2023 for year of what? 2023. Remember, this is the time we are doing 2022 tax return. Am I right? So when you are doing 2022 tax return, folks, if you already knew you are going into, in 2003, when you are doing 2022 taxes, you already knew your 2023 is not going to be so great. And you should already do the mark-to-market election. Okay, so when you did that, then your 2023 will be treated as a business. And let's say you lost $1 million. $3K right here, limitation? No, you don't subject to the $3K limitation. And you can reduce your $1 million cost with your income. And now, what is your income? Maybe your W-2, maybe your K-1, maybe is your other capital gain. All of your income on your 1040, that loss can come in to offset. So let's say you got $1 million gain in 2022. You have an income for $1 million. Now you have this $1 million loss, so you would pay 0 taxes, right? This is how these losses come to play, whether it is a loss that you're gonna lose everything, but you can only deduct 3,000, or it is a loss that you can offset your income. But what if you say, well, okay, I got $1 million loss, but even if I offset my 2022 income, I would only be able to offset half of it. I still have $500,000 loss. I cannot offset because I have no income. That is called carryover losses. You can always carry over your losses. And if you didn't really use up 500,000 in this year, then next year when you make income and your carryover negative will come in to offset your income. So you're still gonna end up not paying taxes. And this is where folks, nowadays on media, you cannot get away not to watch what's going on with our prior president, right? So he's under so many scrutiny right now. And one of his taxes thing is that he doesn't pay taxes. And he doesn't pay taxes is not because his operation is bad. How could that be bad? And during his presidential years, I bet you his hotels are making a lot of money. And those kind of things coming in, he still don't need to pay taxes. It's because of what? It's because of all the carryover losses. The carryover, I don't know his taxes, I'm speculating, but carryover losses is the one that coming from the history. So he lost, so many millions. So those millions are always going to be on his tax return. He will never be able to, offset those losses in full, start paying taxes, right? So that's why Trump only pays $700 taxes and there's a New York tax, and he never paid federal taxes according to the social media insiders, right? So with that, it tells you the losses you have on your book, it is really there preserved for you, right? So but of course you don't want to end up in the passive losses side, just $3,000 a year, $3,000 a year. This is not good. So you may ask me, okay, now I have passive losses. I have a lot and I don't really know what to do. And I am actually just have to reduce 3,000. I don't have any other things. So then what I would recommend you to do is to look two things. Number one, to see whether you have capital gains that you are holding on to and you can cash that out. For example, you have a stock that made money, then you can just sell that stock, creating capital gain, $1 million capital gain, then offset your losses, right? So that is one way of doing that. The other way of doing that, it is to figure out whether you can create from other kind of business, creating that gain to offset this, because you could have a K1 that's a passive income, am I right? And then you maybe, you have a rental property, and that rental property, if you sell right now, it is going to be way too much gains you have, but maybe this is the time that you want to get that sold with that gain and you offset this loss, then you ended up not paying taxes. So that is what we call the planning. And if you ended up with a lot of negative passive losses, you want to plan, because we sometimes we receive client transfer their files over, and we notice is that a lot of times those clients would carry like $200,000, $300,000 worth of passive losses sitting on the book and never utilized. They don't even remember anymore. And you want to actively treat it. And, if you have a property and you can, you don't want to sell it to another person, you can sell it to your other entity. So you can sell this property to another entity and go through the proper sell and recognize the gain, your losses, right? That's how you used it up. But on the new one, because you bought it with the fair market price, so your basis stepped up. And you can do more depreciation. And then later on, when you sell that one, it won't have so much gain that you don't know what to do, right? So this is where the passive loss, 3,000, yes, we recognize that 3,000, but you want to treat the rest of the balance actively, figure it out. And if you are not limited by the passive losses, your ordinary losses is going to be just going as your income. So whatever your income you have, your loss is going to offset all of your income and bring all the taxes back to you. This is where I want us to kind of have a very high level understanding of your losses. You only could have two kinds of loss. One is active, one is passive. When you have passive losses, you need to treat it. You need to actively treat it, figure out a way to get that offset. But if you have ordinary losses, you should treat that like your bank deposit because you don't lose it. You're gonna always get it back, okay? And your tax return need to be continuous. That's why you don't want to transfer your tax return from one small preparer office to an even smaller preparer office, just because I am concerned people don't know how to recognize your carry forward losses. If you don't read your taxes between the lines, they would miss it. But those are your money, your profit, your cash is all here. So you want to make sure that all your ordinary losses is offset by your gain. And it's not limited to your business income. It can be your W-2, can be your interest income, can be your K-1 income. So whatever on your 1040, that gives you the AGI total. That number will offset the losses. All right, so I want to kind of stop right here to give you this general understanding of losses. I hope that you are really taking advantage of this knowledge, start planning 2022. I know 2022 mark to market, if you haven't really done the election, and back in April of 2022, when you were doing 2021 tax return, you are late. And there's no such a thing about you can go back on and then, there's no going back, and you are late. So you cannot be treated as a mark to market for the year of 2022. But I know this is the year that we're talking about losses because the stock market is turning it back on us, right? So we lose money on the stock market. And if you are in the position to hold, of course you hold because it will slowly come back. But if you are not in the position to hold and you created passive loss, like I said right here, and there are ways to utilize it. Don't leave it on your tax return and just there because you will forget it. And the people, you change tax preparers, that person didn't put it in, you forever saying goodbye to the money you could have potentially made. So you may ask me that if I forgot about $100,000 of my passive losses in the past, I know I had it before, but somehow I lost it. It's 100,000. You want me to give you a dollar amount, how much a real dollar you lost? Then I will give you that number. It is $30,000 for every 100,000 losses you did not utilize it. So with that said, and go back to look at your tax return and figure out your passive losses and go back to however years you have, 20 years, go back, look to see whether you have passive losses was completely forgotten, especially on the years when you changed your tax preparer. If you change it to us, you don't need to worry. And we are so good with it. We are so adamant about it. So it would not happen. But the preparers with less experience and are not understanding that and may not know, or they just simply oversight, right? So you want to make sure you capture your dollars. And I'll give you the number again. If you have a losses for 100,000, you're looking at a $30,000 refund from IRS and from your state, and that you did not claim and you completely forgotten. Don't do that to yourself. And then let's make sure we do the planning for 2022, and we have a year that even though the market is not good, but we are good. That's a promise. All right. And I will talk to you again on Saturday, folks. Appreciate you and all of you here. And I hope you gained 1 or 2 understanding. And I'll always be here talking to you and give you what I know. All right. Bye-bye.